Good morning, everybody. This is Dan Hussey from AlgoDayTrader.com and now ElliottWaveForecast.com, bringing you our London session recap for our live trading room webinar. It's October 17, 2013, and let's begin with the S&P 500. We could step out, and it's probably a good idea. I'm going to remove some of these smaller time frame measured moves. We're going to step out to a daily chart and take a look at what we're seeing from a larger time frame and how we look at the markets, because this is a little bit different. Without getting too into, maybe we could actually take a look at a weekly just to get all of our price action on here. There we go. Without getting too into how we view markets, we see the 2009 lows, the big recession 666 low, as virtually and really just for an all-time 50% long in the S&P 500. We've looked at this hundreds of times before, but if you draw from zero to all-time highs at that time, you can see how the entire recession made what is called a big flat, a second wave flat. In other words, down in A, up in B, down in C. Nice 5-wave structure in the C leg. And coming up off those lows, we know we have a 1950, 1960 upside target, and I'll be damned if we don't go there. Our profit objective on that target was actually, and this comes back from 2011, we were looking to a time horizon by 2018 hitting that profit objective, but man, is it looking like it could do it even sooner, which would be outpacing, because if you were to actually step back to the 1970s recession, you have the exact same wave structure, a big second wave flat into a big full halfway back long drawn from zero to, at that point, all-time highs. It hit its upside target at that time within 10 years of making its lows, which is why we gave that 10-year time horizon, and we are moving further, faster, stronger than we did back then. It was right about this time in that market that there was a more substantial pullback, and we'll take a look at what that bigger pullback could be if we get it. Now, it's not a reason to sell because we're still in smaller time frame longs from a weekly, in perspective to a weekly, but and longs are clearly still in control of this market. But once you start seeing those smaller time frames break, the hourlies start to hold shorts off the highs, and we're talking pulling into 50%. And then selling off down to new lows. That's what we're talking about when we say a short. But coming up off of the 2009 lows, there's an extension. We call these extensions, and it's drawn from a high of 800 to highs. And this extension traded once into its 50% line, stops below 6218, takes it up to a negative 23.6% target. Same anchor, new high, and then in 2010 held the same extension, same anchor. Pulled up to new highs, again continuing with the 800 anchor, two highs at that time, held the 50% and traded to its negative 23% target. Same anchor, new high in 2011, did the same thing, and ironically enough, these were the lows in 2010 after the flash crash. We continued up to and through targets now and have hit upside targets of the secondary upside targets from this big extension. Now, because we've hit our secondary upside targets and we have no same anchor new high from a weekly perspective, the highs made on the week of May 2nd, 2011 of a 1373 half anchor to now the current highs, we have a big weekly extension long support level down, down at a 1550 level. So that's a pretty substantial pullback if we do get that. More importantly, taking this now down to a daily chart, there is a series of longs off of our prior weekly lows, prior weekly swing lows here at the 1064 level. They traded traditionals once, twice, and then we actually began extensions off these highs. They traded once to target, same anchor new high, twice to target. Well, we haven't hit the second times target, and you can actually see that extension here, drawn from these 1420 highs to 1686 highs. You can see the support level coming in here. Coming in here at the 1550 level. and the lows were actually a 1553, with the level being precisely 1552. I mean, this held to the tick, and we have upside targets currently of the 1748s. Now going down to our hourly swings, and probably better viewable from a 4-hour chart here, we were looking at the move off the 1550 support, and of course there's Elliott wave that we can back all this up with, but most importantly, this is how trend mathematically plays out in the market. Holding from the 1552 lows to the highs of the summer at that time, we pulled back into a late August, early September low at the 1630s. We then traded up into new highs, and the market made yet again a full pullback off of the swing low into the 50% line. It was the 1640s. This was just last week we talked about this level, and it traded to the tick. So we have upside targets now. We're looking between the 1750 for the big weekly or daily long, and of course now 1767s from this big 50% halfway back in the on the 4-hour time frame. Now coming down to a 15. Well, let's go to a 30-minute chart so we can get all the price on it. Coming off these 1640 lows, there were a series of shorts that broke. Upon breaking, gave us an ambush long. Ambush long became extensions, traded once, blew out of targets, became extensions again, that traded once in the gap down to target. You can see how the extension traded from entry to target. Same anchor, new high after targets were made. Traded in a front run, but has ultimately hit upside targets. From that swing, there has been a series of longs that have traded once, twice, and now drawn from the 1706 lows to today's high. There's a next in the series long here. We also have the potential for an extension long drawn from our prior 1700 highs to new highs. Okay, so we're looking now for a support level between 1714 and 1711s in our micros. Otherwise, it's, again, we could have much larger pullbacks. The full swing from 1640s to highs. We have a 1680 support. Then, of course, a retest of 1640s. But at that point, now we're talking about 1550s as a big daily or weekly pullback in the S&P. Like I said, however, longs are definitely in control. And from a 15-minute time frame, this is what we would call a Globex long. In other words, it's just today's low on our daily candle to today's high. Full Globex long aligning with our prior gap fill somewhat here at the 1614 halves. So if we do get a pullback, that's where we're expecting it. Going down to the micros on the S&P and coming up off of our lows from overnight, there was a full halfway back long. Traded in a front run of 2 ticks here at the 1710 quarters. It's a 2-tick front run of the 1709 75s. Traded to target. Next in the series traditional trades. So to target. Next in the series, which is just entry lows to target highs. Trades again. And then we break out of targets. In other words, once targets are filled, there's no new next in the series long. So we're looking now at an extension drawn from the 1716 75s anchor to highs, which trades once to target, extension trades again, extensions trades same anchor, new high, in a front run of 2 ticks, maybe a little bit more aggressive, but 2-tick front run still counts as being quote-unquote traded. And now we can take it same anchor, new high once more. So before we could ever even get this full 50% long, down at the 1714s, we would need to break below the 1720 now support level from these micro extensions. Looking at the tick, we have no divergence. We had bullish divergence. However, the high in price that we just made at 1723s, at that moment in time at 1123, we made a new high in the tick. When price and the tick make a new high for the day at the same moment in time, you have literally the most buyers of the day at that point, which means that's always a point that could potentially and very highly likely is a point of inflection for at least the time being. In other words, we're probably going to see some selling. And we know we need to fall back into the 1720 support now that targets have been filled from our upside extension. And then we'll see what happens from the 1720 level. Okay? Next, let's move on. Nevertheless, we see continued upside in the S&P today from the 1720 support or the 1714 halves. Very likely one of those two areas. Dollar yen, probably important now to step back, take a look at our daily chart. We need more price action. There we go. From a daily perspective, drawn from the highs at the 84 20s to highs of this year, the dollar yen traded back into the 94 50% long level. Ever since then, we have been inside of this range, this ever collapsing range. In Elliott wave, we refer to this as a triangle. And the question is now, is this triangle complete? There's definitely a case for A, B, C, D, and E wave completion. We know in this last leg of this E wave, we talked about how there was what we call an ending diagonal and an absolutely great opportunity to get long coming up off of these lows from the 96.60s. Going down to an hourly chart, we'll take a look at where we're seeing ourselves on an hourly. We've traded back into the 50% short from the prior swing. You can see how we saw this level at the 98.60s get a reaction originally and slowly fail. It hasn't failed from a technical standpoint. In other words, we haven't gone above the 99.10s, which would be its technical failure. But we did fall back and fall directly into a 50% long drawn from the 96.58 swing to high here. And this 50% long, if there's a break in the micro shorts here today, we're going to be firing off a long trade. We see extension shorts off this high, drawn from the 98.36s to lows. And we also see a micro short inside of this level holding, drawn from the entry point to the new lows here. It is testing a 61.8 line. So we start to break above 98 and then above 98.20s. We're looking to buy any dip in the dollar yen thereafter. Okay, for a move and a swing back towards at least the upside targets here of a 99.60. But this is the type of swing now that this triangle, we've just gotten to the point where it has to be complete if it's a triangle. You know, every way you look at this, from momentum based to measured move basis, if this thing isn't complete, the dollar yen is doomed to go completely sideways for an extended period here. And we could ultimately look for a swing all the way up to 108.30s, and that's just the triangle's optimal upside target and the target from our daily extension long from the 94s. That's the negative 23% extension off of this, or really target from this 94 entry. Okay. So going down to our smaller time frame here, be on the lookout for a dollar yen long trade potentially. I know that Pete, I don't know if you're in here with me, but Pete got ambush trader long. Little change to ambush and D trader. We're merging the two products, so it's going to be it's kind of an exciting product merger there as well, because you'll get both the daily swings and the daily, you know, the more the algo alerts we give, as well as Pete's great ability to enter scalps and trade swings in a slightly different fashion. Let's see. Go into the euro yen. Stepping out to our 4-hour chart. We see the euro yen with continued potential upside to the 136.50 and the 137.30 targets. These are simply their 4-hour swing targets. And we haven't been doing much analysis on the euro yen below the 4-hour level. And the reason is because it's been a very slow boat. It's been a very technical boat, but it's been very slow to make turns. And we can show you, I'll show you what I mean when I say that. The prior swing long was from this 29 figure. The 29s traded up to the 134.96 targets. And then, from the 28 entry to the target highs is our next in the series swing. Which you can see how long it took to finally get a reaction off this 131.50 figure. We have gotten that reaction now, and we're still we're looking for what is going to take us up now inside this swing to those 136.60 targets. There's always the potential for a full halfway back here. It looks like it may have tried to trade that, but it was a very aggressive 10-pip front run. So that's why I'm not looking at anything below 4 hours really in the euro yen. because we know it could get there. But look how long, you know, the prior swing, look how long and choppy it was. It did get there. It just took forever to get there. So I believe we're looking at this market more in terms of the euro and the dollar yen factor, and how those two are playing out on a smaller time frame, which is making the euro yen a little less technical on the smaller time frames. The 4 hour, it's still getting there, you know, and certainly we'll look at the euro dollar shortly, but certainly the euro dollar was less than technical. Not less than technical. It was tricky the last week to trade. It was very technical, just on the larger time frame as well. So 4 hour perspective, let's move to our Aussie yen. We're following and tracking the Aussie yen in extensions, kind of interesting extensions, but they are trading to target here. We have hit upside targets, but have held from the prior swings at 50% long. And most importantly, what we're seeing is the next in the series long from that 50% off the swings actually get a reaction here. And then inside this level, we're holding 50% too. So pressing up against highs here, we'd like to see a break through the high. But ultimately, the 93.90 support with an upside target of a 94.80 today, and that's where we see ourselves in the Aussie yen currently. All right, I'm gonna skip the pound. It's really been a tough trade. It's kind of done whatever it's wanted and just followed general dollar weakness. I'm going to go to gold now, and then we'll finish up with the euro after this, after gold. So gold, what a fantastic year it's been for gold. And I say year because this is something important to note. Gold broke its big daily extension level. And at any time you break a trend, you look for potentially a full halfway back, or what we call an ambush, in the opposite direction. And that ambush, I want everyone to realize that ambush short resides up at 1550s. And gold's pullback right now is very reminiscent to me of what we were looking for in 1974 in the S&P and in 2008 in the S&P. Once it's broken its big daily uptrend, there's only one thing for gold to do, and that's pull back into an all-time halfway back long. It's got no uptrend anymore. That's done. It's over. It's not the time to be a bull on gold just yet. So drawn from zero all the way to all-time highs on gold, a full halfway back long is down at the 960s, and we're a lot closer to the 960s right now, slash the 1,000 level, the big psychological level, than people I think realize. And I think we should all be anticipating and all looking for the potential for gold to go down there, and the potential for it to be a major long-term buy at those levels, particularly with the chaos that is the global government and currency market. Gold's a great, I think, long-term asset. It's not making it. It's not a good trading. Right now, it's a good trading asset, not a good long-term investment. Not at this point. It will be, but not right where we see it now. A lot of people have been asking, Dan, 1434s, why do we sell off from there? Well, if you actually, I'm going to put up on this time level. Gold does something fascinating every year. I'm going to put up the year marker right there. I'm also going to put up the prior year marker. But most importantly, I want to go back to the year before and put up every year's marker here. Because at some point, almost every year, gold does something fascinating. It does halfway back in the direction of its trend for that year. So this is just a few years back. Okay, here's the 2010. Let's put in, I don't want a price level, I want a time level. This is something gold does almost every year. And these are each of the, break down each one of the years, right? Well, you can see that full 50% long from year's low to year's high back in 2010. You can see the 50% long from year's low to year high. Kind of get at some point in the year, there's almost always a full 50% long. There it is. This was early in the year. But this year, um, I mean, hell, gold even did a full 50% long in its major pullback. Traded to the 61.8 line too and broke it, which should have been the first signal for gold reversal. But there's almost always, at some point, that gold trades down into that level. 2012 was an off year. It was a trend change year for gold. So you can see we traded in a range all year, and eventually this is where the trend has reversed. Because if you take the 2013 highs to the lows, gold held pretty much to the tick. It's full halfway back short for the year, and that's not something to ignore. So we very well may not get those 1550s to sell in gold. I think the sell already happened. Inside of this level, we've been in shorts. I mean, every 50% short you can draw up in gold has gotten a reaction and even traded to their targets. We have a next in the series short that is dipping in right now, but is still valid. There's a very good case for a full halfway back short now on gold. So looking for 1342 resistance. But ultimately gold is, shorts have been in control. And we don't really see any reason to be a buyer in gold. Unless you're fading it and hoping for those 1550s, we see that as a much bigger sell. Okay, now going down to Euro, and we're going to have to kind of fly through this, I think, because there's a lot to cover. But I'm stepping out to a daily chart on the Euro. Now, no, we're going to go out further. No, daily's far enough. Daily's far enough. So from a daily perspective, we have run into our prior swing short. The difference here is that we've broken through the resistance level now. And these prior highs, we've retested them as broken support, as broken resistance now as support twice, and held them. This is why we're going higher in Euro. We're breaking resistance and holding it as support. And these prior highs, along with this 50% short level that was a short, didn't get any reaction before, but broke back through and then tested as resistance. This is the type of move to expect when that type of level trades and gets retested. Well, guess what? That type of level traded, got retested, and now we're looking for this type of move. Minimally to the upside of the 3720s, because that's the current 4-hour or hourly extension long we are in. But the daily chart, let's remove this short on gold for the moment. The daily chart is in its 50% swing towards a 141 profit objective. And when we come up into, if you see the targets of this 60-minute here at the 137.20s, they're the prior highs on Euro. If these targets fill, we're also going to probably start running stops from this prior high. There are stops that reside that are located in the 137 area and actually extend for about 200 pips to the 139 area. This is going to be a stop run. There's no reason to be a seller here. You're going to have enormous selling pressure to be able to absorb all of these shorts buy stops, because those buy stops are going to drive the market higher, in addition to a whole new round of sellers that were already, people were already stopped out from this high. So let's just take a look at this swing now off the highs. And the reason being is, I'm going to now, something we do is we make it another color. We turn it purple when we know something's there, but it's not getting, it's kind of the other side. The reason I say that there's going to be a stop slide here is because there's nothing in the way of resistance that we see on the Euro until about the 138.20 level where the 61.8 line is. But we know there's going to be a whole nother round of stops at that area that will fire off because of all, that's where these shorts, most of these actual shorts have their stops. They have them anywhere in this area. So over the next few days, we'll see what kind of business the euro dollar wants to do to the upside here. All right, and finally, going back out to an hourly chart, 180 days hour. The series of longs here is continuing. We are holding the 134.86 support. It traded 3 times, and just absolute failure to break below these lows. And you can see it just became a launching pad. They broke yesterday's Globex short. They pulled into a long, perfect 50% long off of lows. It was front run by 4 pips. The 16s were the low, 12s were the entry, the actual 50, and then from there it's just been up, and away. So now, because this original long blew out of targets, we're looking for potential extension drawn from the 35.50 anchor to highs. That gives us our hourly support at the 36.20, and that's the support level that, if we do get a pullback, we're going to look for support down in that area. But currently we're holding actually a new micro extension. But most importantly here, let's bring up I'm going to add a study to this. I'm going to add the awesome oscillator. Let's see if I can find it. The reason I'm adding the oscillator is because it's important when you're doing Elliott wave. It's important to look at and watch. Okay, so coming up off of our prior swing lows, which I'll put a price level there, down here at the 131s. Coming up off these lows, we're looking for a 5-wave sequence to play out. And there's a reason we're looking for 5 waves. And it's because we've gotten in the oscillator wave 1 high, wave 3 high, and now the wave 5 of 3 high, or 5 high. So this is your 1, 2, or 1, 3, and 5 waves. So this is 1, 2, 3, 4, 5 wave structure. And let's take a look at what that looks like using both Elliott wave as well as oscillators, okay, and measured moves for that matter. So coming, we are tracking the sequence, and you can see each wave is labeled here at its most extreme. So the wave 3 of 3 high here, it is the highest peak on the oscillator. We had a minor wave 4 and then a wave 5 divergence in 5 of 3. Okay, so this is your wave 1 structure in 1, 2, 3, 4, and 5. Your wave 2 pullback. Your wave 3 structure in 1, 2, 3, 4, and 5 in the oscillator, and then your overall, your big wave. Then you have the whole wave 1, all of wave 3, and then all of wave 5, which has yet to complete in your larger 5-wave structure. It's a very fast 1-2, if but it is it. In corrective waves, this is basically a perfect corrective wave structure. In other words, your A wave and your C wave, or your 3-wave structure, you actually the final wave actually has the strongest momentum, and you don't get that divergence in a 5th wave that you get between 1, 3, and your 5th wave. You see how the highest peak, and then you get a new high in price with diverging in the oscillator? That's a 5-wave structure. This is a 5-wave structure, and we're looking for that completion of that 5th wave. So we know we're in our wave 3 of 3, your wave 3 of 3 of 5, right? Your strongest wave. We're looking for that 4th wave pullback before that final push up into measured move profit objectives. Elliott wave, just counting wise, we know this is what we're looking for. And if I want to I should have probably put these on the chart, but there's your little wave 1. There's your little wave 2. Here's your wave 3. We're looking for that wave 4, down into some support level. We're looking for the, at maximum support coming in down at 136.20. It could happen before then, because we know we're holding micros, and that micro could count. And then, that final 5th wave up to complete a 5-wave structure off of that swing. And then we can talk about that bigger pullback. So this is a major reason why we've continued looking for the euro higher, outside the fact that it's holding 60-minute measured move longs from the 134.80 area, is the fact that this wave 3 needed resolution. And we're finally getting that resolution in this 5th wave. And you can see the oscillator starting to turn over as prices, found resistance, and ultimately, we're looking for this same kind of structure right here to appear over here. And so we need, in the oscillator, it's going to look a lot like, coming down into a wave 4, coming up into a wave 5, and then, completing in that last piece of divergence. Okay? So we've been tracking this for a very long time. and very, very long time. And literally, I mean, since this wave 3 of 3 high. So it's been, when I say a long time, I guess it's 3 weeks of tracking this at Elga Day Trader. But I hope you guys find this interesting. This is one, how you use, fibs in conjunction with momentum indicators to validate Elliott wave. And it's an extremely important extremely important to use with Elliott wave, because Elliott wave alone, if we all sat down and looked at this chart and gave a wave count, we're going to probably all come up with some different wave count. But there's only one wave count that's right, and it needs to be validated by both, in my opinion, measured moves and oscillators. And this is why Eric and I are pretty much identical in what we do. He uses almost the same style of trading to so anyway, I hope you guys enjoyed this. I've got to go take a quick little break here, but we'll be back with you shortly. Anyway, yeah, so looking for continued upside in the euro. Probably continued strength in the U.S. equity market. The move for today looks like it's happened. This is, expect the markets to maybe take a breather here. But ultimately, we'll be back with you guys. Excited to be a part of the Elliott Wave Forecast team now. And we'll be back with you guys as price action develops today.